I can't be the only person in the world that thought dollar cost averaging, or DCA, where we invest a little bit of money into the markets over time, was the best strategy for investing. So when we hear that lump sum investing, or taking one huge position all at once, which just feels way riskier, works out to get higher returns a majority, 68% of the time, naturally we're going to want to know the details. Investing is almost never black and white, it's almost always a shade of gray. Each of us has our own risk tolerance and overall goals. So I do want to emphasize that this isn't financial advice. This is me presenting some interesting data and what we can do with it to maximize our returns. My name is Raj. On this channel, we talk about money. Thanks for hanging out. First, let's get some things clear so there's no confusion. For the purposes of this video, we are not referring to when we get our regular income, take a portion of it, and invest it into our IRA, 401k, or other investing accounts. We are referring to a situation where we get a lump sum of cash and want to invest it. Maybe we get a bonus, sell some stocks, crypto, property, or a business. A YouTube video we made gets a bunch of likes and views and people subscribe for more content. Or maybe an inheritance. If that last situation is the case for you, I'm sorry for your loss. It gets easier, just give it some time. In any case, we end up with a significant pile of cash. So we have this lump sum of money, and we'll consider backing up the truck and investing all of it at once. We'll set the money aside and invest a portion of it every so often until it's 100% invested, or we'll just leave it alone. We hear about dollar cost averaging all the time from basically everyone in the finance space, including myself. In fact, I'm literally dollar cost averaging every day into Bitcoin, Ethereum, Dogecoin, and SCHD at the time of making this video. That's because there are clear benefits to the strategy. First, we don't have to have a huge amount of money all at once. We don't have to worry about timing the market to try and get the best price possible. And assuming we hold the positions, we still get the benefit of long-term exposure to the markets, which historically has worked out well for investors, specifically in the S&P 500. But what if we do have that large amount of capital ready to be deployed? We have to make a decision on not only what do we invest in, but how are we going to invest it? Let's get into why YOLO, tossing it in all at once, is actually a viable strategy, even though on the surface this feels super risky. This is coming directly from Vanguard, the company with $7 trillion in assets under management, no big deal, specifically from authors Megan Finley and Joseph Zorn, and it's titled Cost Averaging: Invest Now or Temporarily Hold Your Cash. From this figure, we can see that one reason why lump sum investing is so effective is because we maximize our exposure time to the markets, and we all know the famous saying, time in the markets beats timing the market. A real-life reference is the fact that everyone who bought at the cycle top for Bitcoin in 2017 at a price of around $20,000 would now, 7 years later in early 2024, be up more than 2x if they just held. And this could go up even more if a bull run gets started, which means you could have bought in at the absolute worst time last cycle and still made a profit today just by being in the market. We can see the same overall upward trend with the NASDAQ and the S&P 500. If we did happen to buy Bitcoin at all-time highs in 2017, it is true we would have been in the red for a long time. It's not guaranteed that Bitcoin would have gone up, and of course there is opportunity cost to consider. But we do seem to be in a period of time where, broadly speaking, it is punishing to not be in the markets. We can't lose big if we're not in the markets. I agree with that. The only thing we have to worry about is inflation, but we can't benefit from the markets if we're not in the markets at all, and the longer we're invested, the more likely we are to succeed. So in this paper, the authors compare the performance of cost averaging with lump sum investing across various markets, historical periods, and simulated return scenarios to determine which strategy most often works best. And they state that their results apply to global markets as well, but they're reported as one figure. Based on their data, lump sum investing beat cost averaging 68% of the time. Cost averaging versus staying in cash won 69% of the time, and lump sum investing outperformed 70% of the time versus staying in cash. So there's a lot of data on the next few pages of the document going over how they came to this conclusion, but the quick summary from Rachel Camp CFP is that the reason why lump sum investing won most of the time is because the markets did well, and the longer the buying period, the worse the dollar cost averaging performed. This is because there was less money in the markets to capitalize on the upswing. Now, from this chart from dollarsandData.com, we can see that it was actually numerous markets that had the same conclusion. Lump sum investing outperformed a majority of the time in assets like Bitcoin, gold, as well as the S&P 500. Now, I know what you're thinking. Cash? Raj, cash is trash. How the heck did cash even win at all? What were the circumstances when lump sum investing was not the best strategy? Why isn't this a 100% victory? What about the times when lump lump sum investing lost? Well, that's because the market goes down too. Obviously, if you put all your money into the markets in 2008 right before the crash, you took a huge loss. But if you dollar cost averaged in, you ended up protecting most of your capital because it was never exposed to the drawdown. It was never in the market. You would actually be benefiting by dollar cost averaging down, which ironically is when it's hardest to stick to the strategy because prices keep falling. And nobody likes losing money, and we usually have no clue when the market is going to bottom or how long it will take to recover. On the opposite side of this, dollar cost averaging in a rising market wouldn't be as effective because you are increasing your cost basis, but psychologically this is much easier to do because, well, to put it simply, number go up. Here's another real-life element to this situation. Most people with a lot of cash on hand would most likely leave the money in cash for a lot of reasons, one of them simply being convenience. What if we invested in T-bills while it was sidelined? A treasury bill is a short-term US government debt obligation backed by the Treasury Department with a maturity of 1 year or less. So we give the money to the government, they give it back to us with interest. How does this interest affect the performance of the strategies? Well, in this situation, lump sum investing still won, but as expected, it was slightly less of a loss for cash. Now, even though the data says that a majority of the time lump sum investing wins, there is a situation I can see, and the authors of the Vanguard article see as well, that might apply to you. Some investors just aren't comfortable with the risk of putting it all in at once. And that's okay, because both dollar cost averaging and lump sum investing beat cash a majority of the time. If you are risk averse, you can still win, you just might have to accept a higher probability of lower returns compared to the other strategy. Now, this is probably the most important part of the video. In this part, we will address the concerns of risking all that money at one time. There it is, we get the money, but we're just not super comfortable putting it all into an investment at once. In some cases, this is a huge amount of money and could be one of the largest purchases we make in our lifetime. We have to get this right. Depending on how large it is, one concern is that we might be in a position where that money can be used for something else. Maybe there's not enough in our savings account, maybe there's some high interest debt we want to pay off, but let's assume we can totally afford to put the money into an investment, but we're still on the fence because we might lose money. Well, we might not be investing in the right asset. Yes, it is true a market crash could happen at any moment. Yes, investing has risk of loss, but if we're in the right asset and we have a high conviction, it might be the right move and worth the risk. But if we don't have this conviction, if we're not willing to ride out any potential storm, why would we consider putting any money into the asset at all? There's no point to even consider dollar cost averaging if that is the circumstance. For me, when I'm conflicted about an investment, it's usually because I don't know enough about it, specifically its potential downsides. Once I have that information and I decide it's still worth it to invest, whether it's the S&P 500, SCHD, Bitcoin, covered call ETFs, or microcap cryptos, to protect me from what I can't predict, I just make sure to never invest what I'm not willing to lose. It is very boring and it is very annoying when something runs up and I feel like I could have made more or should have bought more when I had the chance, but it does limit my risk. So I'm okay with leaving profits on the table because it means I also don't sink my entire portfolio either. So based on the data, if we get a lump sum of cash, we have a few options. Keep it in cash, dollar cost average it into an investment, make a lump sum investment. Assuming we don't have any other needs for the money and we keep it in cash, we could collect interest on it using bonds, T-bills, or some other super safe investment, or even collect interest in a high yield savings account. If we decide to lump sum invest it, we would most likely be better off from an overall returns perspective doing this, given the markets have a general trend to go up, and this maximizes our time in the market. If we decide to dollar cost average, we risk losing out on returns, but this may be better for more cautious investors. Lump sum investing works a majority of the time, but does have its downsides, specifically in the case if the investment loses value, but this does beg the question if we have a high enough conviction and risk tolerance to even be in the investment to begin with. So we all have a decision to make when it comes to our money. So let me know your thoughts on this data down below in the comments. Thanks for watching. Be sure to subscribe for more content and click the like button if you found this video valuable. I'll see you in the next one, and of course, good luck in the markets.